Inflation hit a 40-year high this month as U.S. consumer prices soared nationwide. While we associate inflation with higher groceries, gas, and other costs of living, some might be wondering, could inflation break your nest egg? So joining me now to discuss retirement planning is Rebecca Walser, president of Walser Wealth Management. Thank you so much for joining us this morning, Rebecca.
Thanks for having me.
So the general wisdom has been to expect about 2 to 3% inflation when you're planning for retirement. Do you think that remains true, or should people plan for even higher inflation rates?
It's a great question. And I think right now, yes, we should, because we're in the midst of it, right? And we actually have it. But if you look at what happened between 2021 and 2022, a lot of employers stuck with the traditional 3% sort of average annual increase, because at that time they could say, well, maybe it's temporary. It's not really impacting long term. And, obviously employers don't want to get locked into an inflation adjusted salary if then the numbers come back down. Mm-hmm. So one of the things that we're seeing being used as retention bonuses, after the Great Resignation of 2021, we had so many people exit the workforce that you already saw higher wage increases year over year, but also employers implementing a retention bonus to get people to stay. And this is a way they could also, account for inflation, but not lock that price increase in forever on that salary.
That's interesting. So, this might be a good time to negotiate a higher raise, perhaps, or a bonus like that you're talking about. But what other strategies besides that can viewers keep in mind as they plan for their retirement? And for those who are actually much closer to retirement, do they need to worry about recent volatility in the stock market?
Yes, and that is probably the largest concern that we have for people that are very close to retirement, because what we know is if you experience a substantial loss within 10 years before retirement, that can really delay or impact your retirement plans for the rest of your life. It can have that big of an impact. So it is very important for people that are that close to retirement to really be cautious in this time where the market is coming back, where we do see inflation, we do see a lot of, geopolitical unrest. These are all things the market does not like and will probably make the market pull back to its mean. And a mean is looking at the last 2 years before Corona. So that could be a substantial pullback. And we definitely do not want people to experience that are close to retirement. So what I would say as a general principle, without giving specific advice, is to maybe look at being very cautious and even maybe move your portfolio temporarily to what we call TIPS, which are basically Treasury inflation protected securities. They're Treasury inflation protected bonds, Treasury bonds, and they will help mitigate the inflation impact, at least for the short term.
You talked about employers, doing things to retain employees. Are they also doing things to help when it comes to retirement?
I haven't seen a lot of new ideas yet. The retention bonuses are really kind of the first thing. I think employers are just right now grappling with how do we keep this staff and not make them, pants on fire with inflation where they can't afford their, they're just basically covering their rent, their food, and their groceries. How do we deal with that immediacy of the problem, because that is very immediate? And then I think the retirement benefits are going to be coming later on, where we're really trying to deal with these immediate problems right now of making sure people have enough, but yet we don't overlock in and lock in inflation rates that maybe might come down, and we hope they come down.
Right. Yeah, we do. Fingers crossed. Rebecca, great information. Thank you very much.
Thank you.